Okay, we're live.
Okay, thank you. Thank you, team in New York. Robert Van Batenberg is here. Dr. Van Batenberg is in the house. Uh, Ladies and gentlemen, thanks for joining us. Happy New Year from the Bear Traps Report. We have written a blog that went, pretty well read around the world. We work with institutional investors in more than 20 plus countries. And one thing that, kind of buy side mutual funds, hedge funds, really I think the smartest investors in the world are focused on the bond market right now because of issuance, because of the debt ceiling. And we've had a big move up into the inauguration. But at the end of the day, it's really a little bit of a time bomb that's been left for the next administration, which we're going to get into. It's very important that you understand this. Robert's been working with our institutional clients around the world. We've hosted private calls. We're getting a lot of questions, and that's why we wanted to address this here in this forum. Rob, walk us through, first of all, why is this important to investors right now? I know the legendary stories of the Bush administration when they came in after Clinton. And don't get me wrong, Republicans and Democrats, these games happen, right? This is not partisan. But the legendary story, which is pretty humorous, when George W. Bush won against Clinton in 2000, they came in and all the W's were taken off all the White House computers. And this time around, we're looking at the debt ceiling, we're looking at spending in the first quarter of the new year, and there's a lot of really kind of time bombs that have kind of been left for the new administration to clean up. Rob, why should people care about this right now? What do you want to talk about first?
Well, the one big time bomb is that a day after the inauguration, Janet Yellen, I mean, that's not a coincidence, that essentially the US government ran out of room under the debt ceiling. So she's been flying for a while that
Now,
Congress.
why should investors care about that?
Well, it's an interesting dynamic that when the U.S. basically bumps up against the debt ceiling, they can't issue any more debt, right? Because the government or Congress doesn't allow them to raise more
So
debt.
net debt. So they can sell bonds, but they just can't. They can sell bonds, they can sell treasuries, but they can't increase the debt ceiling. So they can sell debt.
Right, right, right. So start from the beginning. So there are two things in Washington, D.C. There's the budget and there's the debt ceiling. The budget is congressionally approved, whereby essentially Congress gives the executive an amount of money they can spend in the year. Okay, that's their budget. But now there's the debt ceiling, which it's a separate track. And Congress also has set a limit of how much debt they can issue. So the budget is the budget, and they can spend whatever they want. I mean, whatever is stipulated in the budget, which is something like 7 trillion. But in order for them to actually spend those dollars, they would have to, above and beyond what they generate in revenues, they'd have to issue debt. So the separate debt ceiling has to be voted on. It hasn't been voted on yet. So now we're up against that ceiling, and then they can't issue more debt. Yes, you will still see auctions because they have to pay back maturing debt and they have to refinance that. But net new debt cannot be issued unless Congress raises the debt ceiling. Hello?
Okay, Rob. So net bottom line is the extraordinary measures, like for investors that are watching us, why should they care? The extraordinary measures don't run out until what, June, July?
Right. So the once you're under the debt ceiling, and Yellen has said this already, she will use extraordinary measures to stay under that. It is basically comes down to, for example, no longer refunding or replenishing the civil service retirement disability fund to postal service retiree health. It's all that stuff, basically government entitlement funds that she will no longer fund, and that allows the government to stay under that ceiling until the end of until August. Why is this important? Is because right now we have a unified government. Trump is the president, Congress, the Republicans have control, but in the House, which is critical here, the Republican majority is very, very, very small. It's about now, right now, to 218 seats over 215 seats. So they have about a 3-seat majority. Why is this important? Is because the fiscal hawks, which are all Republicans in the House, can now use the leverage, and there's about 20 of them. They can use all the leverage to get as much spending cuts or get as much fiscal restraint as they want, because they know that they have the power, because with them, only with them, they can raise that debt ceiling.
So this is important. So because the majority is so small, it sets up an unusual dynamic where a very small group of people, could be 20, 30 people, the House reps, have enormous power relative to other points in history.
Right. And they will, if you can remember, in 2017, Trump was governing with a 241 seat majority in the House. So he got a lot more done. Right now, and of course, the debt picture is horrendous now. We have more than $36 trillion in debt. That was more than double that like 8 years ago. So the fiscal hawks feel that they feel vindicated, and they're going to use their power to drag on this negotiation out the debt ceiling as long as possible. I mean, that they could do that. There's also a scenario in which they could raise it next week, but we think it's more likely they're going to drag on because they have so much room. Because the X date whereby the US starts to technically default is not until August. So they have a bunch of room until maybe by the end of spring. And until then, the US can stay under that debt ceiling, meaning no net issuance. But the deficit continued to build. So you get this, I should say, we're in the eye of the storm for a while, and then suddenly a wall of issuance is coming to the market. Once they finally raise that debt.
For why should people care about that? So think about historically, what happens is, say you have a bond sell-off, everybody knows there's a lot of, so 25% or something like something like 25% of total US debt comes due this year. And about 40% of that's in the first quarter. So a lot of people were selling bonds. A lot of bond bears were kind of running the show over the last, several 8 to 12 weeks. Now, what's interesting, what you're talking about is bonds are rallying. And as you can see here, historically in the chart, bonds tend to rally into these periods when we can't issue any new net debt. You can issue bonds, but they have to be up against redeeming bonds, right?
Right.
And so it's interesting that as we got to this moment, bonds have started to rally again, right? And what you're talking about is once they do raise the debt ceiling and then they can increase issuance again, they got to catch up, and that's where you could get a bond puke. I guess that would be like August, September, October in there.
Yes, or whenever Congress gets to the point that they can raise the ceiling. So right now you're 100% correct. You've seen those yields go up because Trump got reelected. Everybody's thinking he's going to do some fiscal stimulus. You've had Biden spending a lot of money in the last couple of months of his tenure because while he still had control of the budget, he's been basically sending each and every dollar that he can get his hands on, send it out in the form of subsidies for semiconductor manufacturing plants, in the form of all kinds of payments. So we've seen a big spike in monthly spending, and that has translated.
So let's get into that. So just to keep everybody on the same page, the first quarter of the new Trump year, Biden spent what, $800 billion, which is 38% year over year increase in spending. in the first quarter, and that just took place?
Yeah, exactly. He spent a lot more. He spent more than $2 trillion, but it's
Oh, I'm sorry, it's 800 billion of deficit spending.
800 billion of deficit spending. Yeah. So it's and that's 200. He has spent $200 billion more than in the same quarter a year ago. So he's been pushing out a lot of money, and that has been driving up first quarter or fourth quarter GDP expectations. It has, of course, also left its mark on the in the treasury market. And then on top of that, you've had, of course, the whole expectations about Trump and his fiscal stimulus. So yields have gone up a lot. And right now, you're going into an air pocket because there's no net new issuance that can affect the bond market now, which is generally positive for bond prices, whereby yields are going down. And then on top of that, you have some other factors that could also play a role. Um, for example, the market expects sometime this quarter or next quarter that the Fed will stop selling bonds out of its portfolio called quantitative tightening. And the longer we stay under the debt ceiling, the more likely it is that the Fed will stop selling treasuries out of its portfolio, which could also provide relief for the treasury market, right? Because the Fed has been selling something like $25 billion per month in treasuries since May of last year. And before that, they even sold even more. So that could also play a role. And then you have, of course, the regulatory relief. And I think that Trump wants to get this through relatively quickly.
So why should people care about this? You're talking about reasons why bonds could rally in the short term.
Yeah, so bonds.
Explain what that means. What does regulatory relief mean? That forcing the banks to buy more treasuries?
Yes, exactly. Because they know that basically the savings fund that Biden had, called the reverse repo facility, is empty now. It was more than $2 trillion was in there. It's empty now. Why is that important? Because this same thing happened in 2023, where Yellen was under the debt ceiling for until the end of the spring, and then a bond deluge hit the market where the Treasury was forced to catch up on the deficits and spending all these bonds. And what Yellen did was she issued mostly bills because she knew that the money in the reverse repo facility would be buying those bills, essentially harming the market, very little harm on the market. Right now, that facility is empty, right? So the Biden administration has left Trump with nothing to fall back on to
Okay,
sell
so
those
let's
bills.
explain that. So this is really important. Say you want to borrow $5 trillion, right? If you do that in 3-month bills, 6-month bills, whatever it is, if it's 3 months, 6-month, 1-month bills, that $5 trillion doesn't move in price. Doesn't move. But if you have to borrow $5 trillion of longer dated bonds, say anytime in the last year, if you did that, those bonds would have moved violently in price. And so think about this. This is the stat that blows people away. Last year, total debt issuance of all bills and notes and bonds was $26 trillion. And that's because they issued a lot of 1-month bills and that don't move in price. They issued a lot of 8-week bills that don't move in price. And they didn't want to issue a lot of longer dated bonds that move violently in price. There's an Apple bond right now, a 2.5% bond, matures in like 30, 40 years. I think it's traded down in the 50s, like 50 cents, 54 cents on the dollar. So longer dated bonds move like this. Yellen in the election year didn't want that to happen. So she issued 26 trillion of total debt. A lot of it's very, very short term. So she took bond volatility out of the market, placed it into 25. Now, Scott Bessent, we've been told that he's not happy with this. He's talked with different journalists. The story's out there that he has to term out the debt and issue longer dated bonds. So when does he have to do that? And how does that set up with relative to the debt ceiling? And when's he have to really start to term out the debt, or when will he?
Well, as long as the U.S. stays under the debt ceiling, he doesn't have to do much because he can't issue net debt. So all he has to do is essentially refinance the maturing debt. The terming out, the pushing, the extending the duration of the debt profile of the U.S. government will come into play once Congress raises the debt ceiling. So he's not crazy. He knows this, and he's going to try to push for regulatory relief. There's some simple things they can do so that the banks can actually take on more treasuries. They can buy more treasuries without getting punished by it. There's a thing called the supplemental leverage ratio, which if they make treasuries exempt, then banks can buy more treasuries. That's an easy pool of potential buyers for treasuries that he can tap into if he has to sell more longer dated bonds. And I don't think he has a choice because, like we said, the reverse repo facility is empty now. So they can't rely on that to sell this
Okay,
mountain
so
of
let's
bills.
talk about this. Getting back to the RRP, because the RRP is what because T bills versus the RRP. That's the RRP going down creates a problem in February to some extent. Even though we're up against a debt ceiling, Rob. My question to you is this: if 20 if this 22% of total U.S. debt is maturing in February, even though you're up against a debt ceiling and he can't issue any more net debt, what if he does term it out? What if he issues longer dated paper? Wouldn't that still put pressure on the bond market?
It could. I would be surprised because generally, when a bond matures, like say you say have a 3 month bond, they basically match it with issuing a new 3 month bond, right? So they will issue a 3 month bond, and then the investors that hold the maturing one roll it into the new one. If you have a 10-year bond, then the investors that hold that one will roll it into a new 10-year. So the maturities and the issuance are generally rather matched. So that's why I say he doesn't necessarily have to worry about that too much. Maybe he'll try a little bit in the margin, but by and large, the audience that is buying a 3 month bond or a 6 month bond or a 12-month bond is very different than the ones that are buying a 10-year or a 30-year. So without upsetting that balance too much, like for example, this is also the reason why so many of the debt maturities are concentrated in January, February, March, and April, because a lot of that debt is bills with a very short maturity. So February may see a lot of 3 month and 6 month maturities whereby they roll them back again into other 3 and 6 months. So then it pushes it out to May or August, right? So that's essentially what he's dealing with. Now, if and when they raise the debt ceiling, wherever that might be, then he will face the challenge of pushing out the duration in the debt profile, which is another reason why the Fed should stop and is likely to stop selling bonds out of its portfolio before that to
Okay,
alleviate the long
so
end.
let's get into that for a second. So we know the RRP is gone from $2 trillion down to like around 100 between 100 and 200 billion. And you have to explain why that's important, because if T bills are here in yield and the RRP is here in yield, which is a facility, the money will leave the RRP and go to T bills. And so what you're saying, Rob, just think about what you're saying. If 21 or 22% of debt rolls over in February and they're issuing bills again, and the RRP is really low, doesn't that stress liquidity at some point, because the T-bill yields are going to be high relative to RRP? It's going to continue to drain the RP. So the Fed will get forced at some point to end QT and move toward QE. Is that what you're saying?
Well, the Fed, yeah, will turn into buyers of treasuries because the Fed has two sets of assets. One is its treasuries, and the other one is mortgage-backed securities. So right now they're selling both. But if once they decide to stop selling treasuries, all the proceeds from the maturing mortgage-backed securities will then be used to buy treasuries. So the Fed turns from a seller into a buyer. So that's why many Wall Street banks estimate that the Fed will buy roughly something like 300 to 400 billion dollars of treasuries this year, depending on when they stop quantitative tightening for treasuries, because they will use the mortgage-backed securities proceeds to buy treasuries. So that will provide relief for Scott Bessent to push out the maturity of the debt, which he has to do. Now, with respects to the RP will probably stay at this level, and in fact may actually increase the longer the U.S. Bumps up against the debt ceiling and has to revert to extraordinary measures to stay under it. Because you'll actually see the amount of bills decline simply because of the dynamics of staying under the debt ceiling and not being able to issue more debt. So that's one of the dynamics, but it really depends on how long they stay under the debt ceiling. If this is only a month or so, that doesn't play a role. If they drag this out all the way to the end of Q2, it will definitely start driving up the RRP a little bit and also bank reserves. But that comes down to a more interesting thing because we're talking about the plumbing of the treasury market. The more interesting aspect is which pertains to I think every American is that how unified is the Republican Party really under Trump? Right. So, how willing are they to quickly meet his agenda? Because based on, for example, raising the debt ceiling or getting like certain legislation through reconciliation, which is the process whereby they only vote on party lines for legislation. How quickly they can get that through will tell us how much fiscal stimulus Trump can push through the course of the next 4 years.
So if there is a really tight house, which we know there is, and if Biden did, like we said, 800 billion of deficit spending in the first quarter, doesn't that cause a debt, like a fiscal cliff later in the year for Trump? In other words, let's just say the GOP doesn't want, like Biden essentially spent almost $2 trillion last year in deficit spending, deficits.
Yeah.
And now he's jacked up in the first quarter another 800 billion of deficits. And let's just say the GOP is stingy on spending, you know, when they go into the debt ceiling, then doesn't in the second half of the year, couldn't the deficit go from like 1.9 trillion last year to maybe 1.4, 1.5? So we're taking down spending 500 billion this year.
Yeah, so they're front run spending already. So I think Trump will have no choice but to cut spending in the first quarter or in the second quarter. So that you'll already see a slowdown, which could actually help bonds as well in the first couple of months, right? Because bonds do well when the economy slows down. And I think the fiscal hawks have so much leverage right now in Congress they could actually force Trump in some sort of small fiscal cliff, which will definitely impact certain sectors as well, right? That have been relying a lot on government spending, that have enjoyed a tremendous windfall from government investing and subsidies, what have you not. Yeah, so the chart here is the reverse repo facility. We saw that went up by more than went up as much as 2.5 trillion. In
and let's explain this for like the broad audience. What all this means, and the reason why it's important is, you see that big pile of money. That money was what funded all that spending last year, right? So
yes,
that's why they were able to issue do like another 1.9 trillion dollar deficit, 16 trillion of fiscal and monetary response since COVID. 16 trillion of fiscal and monetary response since COVID. And a lot of that was 2021, 22, 23, 24. 24, we went up a lot. And that reverse repo facility funded a lot of that spending.
Yeah, 100%. But that's empty now. So Biden has left Trump with nothing in the piggy bank in order to cushion this wall of money that they still have to issue sometime this year once Congress raises the debt ceiling. So one thing that we can look at from the get-go is how easily some of the Trump nominees can get through. This is, of course, a Senate issue, and that will tell us how willing Congress is to play to cooperate with Trump. And some other negotiations in the House will tell us how quickly are they willing to raise the debt ceiling. If the fiscal hawks show the teeth and are basically an obstacle towards any kind of legislation that comes down to spending, I think that people will start to assume, well, we could be under the debt ceiling for a while, and we could actually wait a long time before we see fiscal stimulus, because that's something else, which plays out in 2025. Trump wants to extend the tax cuts that he enacted in 2017.
Okay, so why should people care about this chart?
Well, you see the Treasury General account is going to be drawn down. The domestic RP, like I said, it's gone up. It will go up the longer we stay under the debt ceiling. And you see the most important part is the reserve balances with the Federal Reserve banks. It's basically what we on Wall Street call the excess reserves. It will go from 3.3 trillion to 3.7 trillion the longer we stay under the debt ceiling, and the longer Congress.
Why is that important for people watching us right now?
Because it's a big driver of risk assets. When excess reserves go up, that's very highly correlated with risk assets such as Bitcoin, also the stock market
Yeah,
in general.
so that's important. So we have a liquidity model, and essentially, when you're long Bitcoin, you're just long excess liquidity. No matter what anybody says, you're just long excess liquidity. In periods of excess liquidity, Bitcoin does well. When liquidity comes down and volatility goes up in markets, Bitcoin underperforms. In August, Bitcoin lost close to 25-30% in like 7 days, right? Because we had a liquidity stress point. And so that's people have to really understand that, because the average small person is not really familiar with liquidity. So we have a liquidity model. Anybody that wants to take a look at it or wants a report on it, it's Tatiana at thebeartrapsreport.com. Tatiana at thebeartrapsreport.com. You can get our liquidity model, which basically goes through excess liquidity and contracting and expanding liquidity.
Right. And so if excess liquidity at the banks goes up, that means there's more liquidity slushing around in the financial markets that will go find their way to risk assets, to put it simply. So there's a very strong correlation between things like, for example, Bitcoin, also gold, but also stocks in general, and excess reserves. So when excess reserves get propped up artificially, but because the debt ceiling, that could actually benefit the market. But once, of course, the debt ceiling is raised, that whole process will reverse. So you have to be careful, because then excess liquidity will actually drain out of the bank's balance sheet. So keep that in mind. That's why that table was so important.
Okay, and so just to kind of recap, extraordinary measures just went into effect essentially last night. All that means is we're up against the debt ceiling, and they have some extraordinary measures that can provide cash and funding to get us through the year out to the end of July. And that's where the default risk really lies. If they don't raise the debt ceiling by that day, by late July, then we potentially face a default. We're not going to default, right? But there'll be a lot of drama in the news and the media, and there'll be a lot of not a lot, but all it takes is a small group of Republicans to make a stand on spending, and the appearance of a default will potentially rise, even though it's going to be a lot of just drama in the news cycle. Is that a good way to explain it?
Yeah, and the fact that it takes so long for us to go from breaching the debt ceiling and defaulting, right? Because we breached it today, and the default happens by the end of July, because there's such a long period of time between those 2 days that it gives the fiscal hawks in Congress a lot of time to debate, negotiate, get their pound of flesh. And they are now in no hurry to act, right? Because we know Congress only acts in an emergency, right? In the 11th hour, we've seen that time and time and time again. So every debt ceiling crisis, but a real crisis, which we don't expect now, usually they act only in the last minute in 2011 and 2013. But now they got ample time, so there's no rush to raise that debt ceiling now. So there's going to be negotiations, and that could, I don't necessarily say with will, but it could drag this out until the end of Q2. And that's what we've been talking about.
Yeah, so I think that's a good wrap up. So net, we've got a lot of bonds for sale this year. We have extraordinary measures. We have also other ways that Congress and or the Fed and Treasury can put out these fires. So there's a lot of moving parts through the year in terms of total bond issuance, but also in terms of games the Treasury can play to satisfy and issue bonds. And then it really gets more interesting toward late July with some drama spots in between now and then. And like you said, a lot of posturing, small amount of politicians that have more power than usual. And so stay tuned. Any last closing comments, Rob? Anything?
No, I think this sets itself up for an interesting dynamic. We've seen a lot of bond bears, right, in the last couple of months coming out. We've seen him talk about fiscal stimulus. We've seen him talking about a lot of issuance deficits and all that good stuff. The Fed essentially lowering rates when it was pretty much too late. The economy is doing well by the time they really went into a rate cutting cycle. Also, ironically, it's like very strangely timed ahead of the election. So that's gave the bond bears a lot of fuel to lean into this bond market. And now are going to be factors that could possibly push it the other way for a while. Most importantly, of course, the debt ceiling, perhaps quantitative, the Fed stopping the selling of treasuries out of from its balance sheet, and perhaps a small economic slowdown because Trump will have to basically cut back on some of the spending because so much has been front run. So I think that that's important for investors to keep in mind.
Yeah, and then the last thing is percent at one point, and it's going to have a lot to do with the debt at some point this year, because of the reckless, just reckless way that we are borrowing so much more in T-bills. Again, we issued 26 trillion of debt last year. A lot of that was 8-week bills, 4-week bills, 3-month bills. And so you're just constantly funding the government on the front end of the yield curve. If Team Trump starts to term that debt out through the year, especially around the middle of the year, that's where we're going to need a lot more help from the Fed, and we're going to need a lot more help from foreign bond buyers, and that's where you have that potential Liz Truss moment where the bond vigilantes really make a stand. But thanks very much, Robert Van Batenberg, and we'll catch everybody next time. Thanks to our entire team in New York for putting this together, Valentina, Jose, and the team, and we'll